Okay, so if there's going to be a dividend, whether it's a private or public company, it has to be declared by the board of directors. And if they decide to stop paying the dividend, then that's what happens. And that's true even on preferred stock, believe it or not. But here they did declare a dividend on March 10th of $1 a share. So what is a dividend? It's a current payout from net income to the shareholders. Payable date seems pretty easy, right? And then this is always the key. In other words, if you want this dividend, you'll be on the list of shareholders as of Thursday, April 14th. What if you're not? Then you don't get the dividend. Oh, should I hurry up and buy it then? No, that's a violation called selling dividends. Because as we're going to see, the share price is going to drop by $1 on a certain date. And anyone who gets it's going to pay some percentage of tax if it's in a taxable account. So no, you can't let your, as an agent, you don't try to hustle somebody into buying this so that they get the dividend, because you know darn well that they could just as well wait and maybe even be better off. So you could sell them this stock because they do pay dividends in general, but you can't sell the next dividend. So the declaration date is March 10th. And the dividend will be paid on May 1st. Hey, that's just coincidence, believe it or not. But you have to be a shareholder of record Thursday, April 14th. So, well, if that's Thursday, April 14th, on the 13th, Wednesday, anybody who buys the stock because of T+2 settlement, their name will not be on the list of shareholders the next day. And so on the ex-dividend date, why do we call it that? On that date, the stock trades without that dollar dividend. If you buy it on the X date, it's too late to get that dividend. And so when they figure out the opening price on the ex-dividend date, whatever it is, minus $1, because you're not getting that dividend. That's an asset that is not going to you. Now, the test question could say, when is the ex-dividend date? Or they could say, when's the last day to purchase the stock and receive the dividend? The 12th. It takes 2 business days. So if you buy on Tuesday, the trade settles on Thursday, the transfer agent sees your name on the list, you get the dividend. So this is equity. I'm an owner. I have a priority claim on first money out, a priority claim on any dividends. And for a public company, it's usually going to be it's a stated rate of return. Meaning what? Well, maybe it's 4% preferred stock. Now with common stock, you have a number of shares. Maybe you own 4% of the company, but this means you're going to receive 4% of the par value. And what else? That's really about it. You're not going to get a bunch of upside. You don't need to watch the quarterly earnings announcements because your stock can't double or triple. You're only really concerned about getting that stated rate. So if you buy $100,000 of this company's preferred stock, you're looking forward to $4,000 a year in income. What else? That's about it. Except you need to know that, as with bonds, if interest rates go up, the market price will drop, which will have no effect at all on your 4%, as with a bond. Oh, I got a dog napping. Sorry, people. If rates go down, the market price goes up, but I don't see why I would get all excited about that either. I don't think I would get excited about it either. I'm just saying you got to make sure that an investor knows this if you're going to sell a preferred stock. It's like the 4% is reliable. This is a good financial company like American Express. They've never suspended a dividend ever. Doesn't mean it couldn't happen. But even there, along the way, while you're getting your stated yield of 4%, market price will go down sometimes and market price might go up sometimes, So it's interest rate sensitive. Rates up, price down. Why? Well, because new preferred stock's coming out paying a higher yield. Yours isn't worth as much. but you're still getting your 4% income. Rates down, price up, doesn't affect your 4% income. Now, there are different features. If it's a straight preferred stock, if they have to cut the dividend or just suspend it for a few years, that's the end of the story. They don't make them up in the future. That happened when Fannie Mae had so much trouble while during the housing crisis. In fact, I'll go back to that when we finish this. Cumulative, this is kind of snake oil, really. It almost sounds like, oh, so the difference is straight preferred wouldn't get their dividend, cumulative would. No, don't draw conclusions like that. It just means that with cumulative, any missed dividends would be kept track of. And then before they could ever pay common stock, they'd have to make up the missed plus the current dividend. But that's not the same thing as saying they're ever going to pay you. But since that's a benefit, if they're going to offer cumulative preferred stock, the dividend rate would probably be a little lower than straight. Because again, with straight, the company wouldn't have to make up missed dividends. Not only do you not have upside when you own preferred stock, so that the increased profits really don't matter that much, but you don't get an increase in the income either. If it's 4% preferred stock, you noticed I made that pretty clear. That doesn't change. Well, the only feature that could make it change is this. This means that if the issuer increases the dividend to common, they're going to increase this dividend proportionally. But if it's not participating, your dividend is always going to be whatever it is stated. So here they might say participating is a type of preferred stock where the dividend is fixed as to the minimum, but not the maximum. Whereas everything else is, if it's 4% preferred, that's it, minimum, maximum. But here it could go up. Just the dividend, though. Doesn't mean the share price would. Callable, as with bonds, the issuer might want to repurchase these. They have to make the terms clear, but maybe after 5 years they can buy it back for 102% of par. Because the issuer could get rid of this tends to pay the highest dividend, callable. So that means if rates go down, there's a good chance that this is going to be bought back from you at a stated price, which is not the worst news, but it's not great news. And then this is really odd. We do suddenly care about the market price and the earnings of the issuer, the market price of their common stock, because if it's convertible, then the market price of this goes up with the market price of the common stock. And so if you had bought, I don't know if they had any, but if Facebook had any of the other types of preferred stock, you would still be getting your stated dividend. You wouldn't have got any of the upside. But if they'd had convertible and you bought it, your convertible preferred would be up proportionally with the price of the common stock, which has gone from 38 to wherever it is today. If you multitask, maybe give me a quote on Facebook. The symbol is FB, believe it or not. We could also have combinations. The only either or, I think I'm shouting again. Oh, I'm excited about Friday and 76 degrees. That's it. It's either straight or cumulative, but after that, it could be all of these right here. There's even an adjustable rate where it's usually tied to the T-bill rate. So right now your dividend would be jack, as they say, or would it be less than jack? I always have trouble with that. So it's either straight or cumulative, but after that, we could have cumulative, participating, callable, convertible, preferred stock. I know that's weird because we like to learn 5 bullet points and keep them in separate pigeonholes, cubby holes. But no, it's straight or cumulative, but it could be cumulative, callable, and convertible. That'd be a great test question. What does that mean? Because of this, the investor knows that what? Well, you have to know what each one of those words means. And I don't see any tricks. Callable, call always means buy. The issuer might buy it back. Convert, this is now tied to the price of the common stock. So there's only one type here that is growth in income, and that's convertible. Everything else is just a straight income investment. So if you want growth, you buy common stock. You could also end up with some income if they pay dividends. If you want income, you buy preferred stock. But there is a very special type that is convertible. Well, what's the catch? See if you can think what the catch is if you whether you have or haven't read our book. If Callable pays the highest dividend, this one's paying the lowest. Hey, tell you what, instead of putting us on the hook for 4%, this is 2.5% convertible. Well, why would I accept 2.5%? Because you get the upside. Oh, so I'll back off a little bit on the income demand, and maybe I'll end up hitting a home run. Yeah, because that never happens for bonds or preferred stock unless there's a conversion feature. All right, so when Fannie Mae had so much trouble, they had all types of bonds and preferred stock out there. The United States Treasury put in $200 billion to buy their senior convertible preferred stock. So for several years, no other type of preferred stock got a dividend. The Treasury got all their dividends back, and the shares were convertible, so that with that infusion of capital, $200 billion, the company's share price eventually recovered, and the Treasury made a profit, which is pretty wild. I mean, that's our money, but the federal government typically gets some type of upside. Up until recently, bailing out a company was just anathema, especially to any conservative. Oh my God. But when they bailed out GM or when they bailed out Chrysler, the Treasury typically gets some type of a conversion feature like that, or a warrant, which we cover under derivatives, some type of an equity kicker. All right, I'm giving you this $10 billion. That's like Warren Buffett. But I need this also to be tied to your common stock because my investment's going to help that go up, and I want to catch the upside. Well, what do we get out of it? Well, I'm charging you a lot lower dividend or interest rate. Oh, yeah, good idea. And I think even some private companies do that sort of thing with venture capital. We want convertible preferred shares so that any dividends will be paid to us. And if this company starts looking good, we get to convert to X number of shares, and then you can forget about the dividends that come out to just us. Or they do that more often with a convertible bond. Here, we'll front you this money, and maybe instead of making interest payments, we'll let you off the hook by just converting and taking over a big share of your company. Yeah. Always have a lawyer there when you're doing a VC deal, from what I understand. So at least 3 similarities between these two, but more differences. So why do they call it preferred stock? Because the dividends are paid to them, whether anything ever gets paid to common. And in a bankruptcy, they have a higher claim than common stock. However, preferred is still below all the bondholders and other creditors. But surprisingly, you got to watch out that you don't try to draw a bunch of conclusions. Well, I figure if it's preferred, then obviously they have voting rights. No, maybe in a private company, but in a public company, usually preferred stock just sits back and collects their dividends. It's the common stock, the owners who get to, preferred stock is an owner too, but the owners who have common stock are the ones who get to vote. And preferred stock, if there's more issued, there are no preemptive rights. Because again, you don't really you're not looking for a share of the profits because they're going to go up. It's just, will they or won't they be able to pay that 4% or 3.5%, whatever the stated dividend is. In general, if I'm looking for growth, I buy common stock. It could be growth and income if they also pay dividends, like Microsoft would be growth and income. Preferred stock is income. And then there's always that wild card. Now, if they come out and say it's convertible, then it's growth and income. But all their type of preferred, it has nothing to do with the price of the issuer's common stock or their increasing profits. But because it's fixed income, it's interest rate sensitive. Rates up, price down. What about the other way? That's not the risk. And even though there are some preferences, you might not get your dividend at all. If the board of directors says we can't pay a dividend, they're just sick about it. And they probably are, because they probably own a bunch of those shares themselves. And even though preferred stock has a higher claim in bankruptcy than common, it's well below all the other creditors. And they're both equity securities. So, we always go back and forth. Should I put this in the equity security chapter, or should I rename debt securities fixed income and put it there? It doesn't fit perfectly either way.